For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for updates.
Hello and welcome to StratNewsGlobal. You are on our daily program, The Gist, and I'm Nitin Gokhale. And on The Gist today, we move slightly away from our usual discussion subjects like foreign policy, international relations, and strategic issues to more basic but an important aspect of global relations as well as global trends, and that is the economy. Joining me in this discussion is someone very well known in this field, Neelkanth Mishra, who heads the Asia Pacific part of Credit Suisse, as also a member of the Prime Minister's Economic Advisory Council, and someone who is a frequent commentator on global economic trends, as well as what happens in India and what one should look forward as far as Indian economy is concerned. Welcome to this program, Neelkanth.
Thank you. Thank you for having me here.
So let me begin by asking the most obvious question. Where do you see the global economy right now? Is it heated? Is it going towards mega inflation or stagflation, as they call it in your terms? What do you see as a broad trend or a broad, kind of aspects in the global economy?
Yeah, so it helps to break down this analysis or this perspective into a pre-Russia-Ukraine conflict, right? So so pre-conflict, what we were seeing was the aftermath of the COVID stimulus, right? So if you think about demand and supply, so in economies, you know that both of these things generally try to match. Pre-COVID, they were more or less in line. During COVID, because of lockdowns, both demand and supply came down in different ways for different sectors. Then in the US and Europe, there was a massive stimulus. In particular, in the US, demand then suddenly went up a lot higher than supply, right? Supply took a while to normalize because factories had time to restart, took time to restart. Supply chains were not fully configured. What also happened was the US stimulus was so large that they couldn't meet demand locally, and therefore demand spilled over to China, Japan, India, Vietnam, Bangladesh, and all that. And when all of those ships started to reach the US, their ports couldn't handle the import volume. So there was a massive disruption, and that caused a huge surge in inflation. That inflation was starting to fade. So because what happened was the fiscal stimulus was then slowly taken off. Supply chains were starting to respond, and therefore production was going up. The port congestion had started to ease, but just about the time that was starting to happen, we had this conflict in late February. What this conflict has done is it has brought down supply significantly. And the most critical, so of course there are complications with food as well, but the most significant one is with energy. And there are two parts to that. The first is the physical shortage of energy. So Russian oil supplies are lower than what they were pre-February. The fear is that what is a 1 million barrels a day shortfall could become a 3 million barrels a day shortfall by the end of this year, because progressively their supplies will reduce. There are similar constraints on gas. And, economic growth is very directly correlated with usage of dense forms of energy. If you walk from one point to the other, you're slower. If you take a cycle, you're faster. But if you take a motorcycle, you're much faster. If you take a plane, you're even faster, right? Same with automation, uses of electricity, using washing machines or refrigerators. So all of those productivity drivers are all energy guzzlers. And if physical energy is not available to the world, global growth has to slow down by that amount. Yeah. The second way in which this affects us or hurts us is that if you take the oil market at about, say, $2.5 trillion before this conflict, and after the conflict, when oil prices are up by 50% and they're still rising, there is a $1.25 trillion increase in transfer from consumers to producers, right? So you and I, the consumer in the US, the consumer in China, they're all now paying a lot more to Norway, to Saudi Arabia, to Abu Dhabi, and all the Nigeria, all of those oil exporters. So the consumers are not able to consume to that extent, and the producers are also not sure how long this lasts, so they're not investing it. Right. And what this means is that there is a very a forced saving in the global economy, right? So collectively, generally, a high price is not a problem because the consumer suffers, but the producer benefits, and all in all, it actually balances.
Gets reinvested also. Yeah, it gets reinvested.
Exactly. So this is a problem at a global level. This is not something that conventional tools like monetary easing or fiscal stimulus is going to solve, because there's a physical shortage of energy. Fiscal interventions will only help reallocate. So if Australia subsidizes it or Taiwan subsidizes it, it will, maybe they can consume more, but then someone has to consume less. And if you add to this the fact that the US stimulus during the COVID time was so large that it has driven what is a very dangerous thing, which is a wage price spiral, right? So that prices go up.
US especially. In the
US.
US.
In the US. This is so far, thankfully, only a US problem. So the US Fed now has to therefore act to break this wage price spiral. And in doing that, they may have to actually trigger a recession. So the markets globally and all of us in the economy have been used to this reality in the last 15 years or 20 years that whenever there is a weakness in the US economy, a stimulus will come.
Yeah.
This time, the Fed and perhaps even the US government wants to break this wage price spiral, and therefore there could be a much sharper. And as they do this, you're seeing what is happening in Sri Lanka. Now, there are many other economies where the high cost of capital could actually trigger similar problems. So the next 12 months are going to be very turbulent for the markets where we operate. Of course, it's already very turbulent. But for the economies as well, I think you're going to see a much sharper slowdown than was anticipated 3-4 months back.
So coming to, the effect on India, especially because we will be interested in that. And there are these forecasts from the IMF, from the other credit rating agencies about India being, or economists had a cover that India is the only hope or will be a driver. With a caveat, of course, as usual, will Modi blow it? Was the caption there. So where are we as far as India is concerned? Are we facing headwinds or a slowdown? And how does one look at the next 12 months, let's say?
Again, let's look at pre-Feb and now, right? So there are many strengths that are underlying what I would call a very resilient economy in India. So the first is that the revival from COVID restrictions has actually been much better than what many feared, right? So there was this very attractive phrase that people use, K-shaped recovery, that the rich were doing well, the poor were somehow struggling, informal enterprises were struggling. Some of that I think is true, but I must emphasize that the revival in jobs and in that 8,000 to 15,000 rupees a month type of jobs in the last 4-5 months has been quite remarkable. Mm-hmm. So as schools have restarted, as railway stations have started working again, as travel and tourism has picked up, the revival in jobs has actually been far better than was anticipated. The second issue is that in an economy with very sharply or very, very steadily growing population and number of households, right? The number of households in India is growing at 2.5%. It is remarkable that for 10 years, the dwelling construction market had been flat in nominal terms, right? So because of the excesses of the previous real estate cycle, which kind of faded in 2011-12, for almost 10 years, the dwelling construction market was going through a correction. It has started to now move up, and that can, just to give you perspective, construction, the output, the value of construction had fallen by nearly 5% of GDP.
Oh,
right, over this period, and it was in the last 10 years. And yes, and it had started to bottom out pre-COVID, and now it is starting to improve quite significantly from here. The third thing is that the worst affected part of lockdowns was the government itself, right? And particularly the state governments, because, as you know better than me, that everything is a physical file, Babu file lana, right? So, and if the work from home is impossible. And so therefore, construction work, repair of roads, repair of irrigation canals, and a lot of capex, which state governments do in the normal course of things, had stopped. And we are seeing in the last 2-3 months that they are starting to do that. They are being helped by accelerated formalization, which is actually helping tax revenue. So it is not really a fiscal space problem. It was actually an ability to spend problem. And that ability to spend is improving now. And then there are these 2-3 other factors. So manufacturing exports have been doing very well. India is gaining share in electronics, in specialty chemicals. It is gaining share in apparel. It had stalled for 7-8 years. It is picking up again. And then there is services. Services, what is remarkable is in the last 2 months, March and April, our net exports of services have hit a record high. The total invisibles, which we call, it's a very Indian name for net services exports, which was about 140, 145 in most people's forecast, could actually be 165, 170, right? So if wage hikes are given by, say, all the global software majors to their Indian employees, and that has actually happened in the last 2 years, last year in particular, that helps the terms of trade. And if anyone has to find 500,000 engineers anywhere in the world, they have to necessarily come to India. So all of these factors are very supportive of growth. So I would have said that real growth in the economy in FY23 would have been 3 to 4% points stronger than what consensus was at pre this conflict.
February.
Now let's look at post-conflict, right? Now, the sad reality is that our energy imports are 4% of our GDP. So if gas prices, oil prices, coal prices, fertilizer prices, edible oil prices, all of them go up, it is a big drag on our growth. So I still think that we can grow at 9% plus real terms in FY23. Consensus has now fallen from about 9.5% to about 7% now. I still think that the growth will be better than what people expect, but it is definitely a challenge for us to offset this sharp increase in our energy import burden. And what it also does is it causes volatility in the sense that you've seen that the rupee has now started to fall finally, and it had to. And when it does that, the realized inflation goes up, which then makes people uncertain and fear that the rate hikes could be quite strong, that the economy could slow down and even a lot more. And so there is I think I would say a 6-month period of macroeconomic volatility and uncertainty, which we need to go through, and then the economy can stabilize and start growing again.
So 2 questions here. Will a good monsoon, an early monsoon, help stabilize or cool inflation? And 2, will the recent steps by the RBI help again sort of temper the hyperinflation that some people are talking about, especially in food and energy? Energy is not in our hands, but what about food? So these 2 questions, I think we need some clarity on.
So food also, there are elements of are food inflation, which are very domestic. So look at vegetables. So in vegetables, like onion prices are currently so low that farmers in Maharashtra are again dumping them and protesting that they're not getting fair realization. 2 months back, the same was the case with tomatoes. Right now, because of the excessive heat that is prevalent all over India now, the tomato, I think, flowering has been a problem, and tomato prices are going up, right? And I think the Rabi harvest was not that strong. Potato prices have been reasonably stable, but again, I don't expect them to fall meaningfully from here. But if the monsoons are okay, more than the early and the quantum, if the spread of the rainfall is smooth. The problem with monsoons in the last 7-10 years has been that they become very chunky in the sense that there is a lot of rainfall in a few weeks, and then there is an extended dry spell. That is actually very bad for crops because it causes flooding, it causes soil erosion and all of that. So if the monsoon is okay, I think the domestic part of it, or especially, and then the second part is milk, which is another 6% of CPI, where India's market is more or less, an island of its own. There is some milk powder exports. Milk powder, SMP, skim milk powder prices globally are up 60%, but Indian milk prices are not going up. In fact, in butter and fat, that is butter and ghee prices had started to go up. Now they are kind of stabilizing. So I think that food inflation in India, to the extent that the imported food inflation, which is oilseeds, to some extent now wheat, because we've exported so much that and our crop did get hurt by the heat wave. So I think there are some risks, but I don't think India will face the same level of stress as some other countries are likely to face, who are mostly food importers. The RBI measures, I think, at least in my view, though of course the minutes say that they are really worried about inflation and all that, but I think the timing of it was perhaps more triggered by an attempt to protect the currency from unnecessary volatility. Mm-hmm. Going forward, I don't think, 30, 40, maybe 100 basis points of rate hikes is not necessarily going to be very impactful on near-term inflation outcomes. Right. What will affect our inflation a lot more is if the US and EU, I think recession is almost a given, but if the US was to go into a recession earlier than people think, and some of the stock market reactions are signaling that perhaps that is sooner than people anticipated. If that was to happen, then there is one element of global inflation. So if you see copper prices are down significantly year on year now, right? So they are below where they were in April 2021. Look at aluminium. Aluminium had peaked at 4,000. It's now at 2,800. And despite all the disruptions of Russian aluminium and the alumina refinery in Ukraine, which was bombed. So there is a non-food, non-energy side where there is a very clear deflationary trend. So we have to remember that during this COVID stimulus and all the supply shortages that we discussed earlier, there was a shift from just-in-time to just-in-case type of philosophy, right? That people were double, triple ordering because they were not getting inventory. Right. So right now we have this. So this is the concept called a supply chain bullwhip, right? So that end demand moves slightly, apparent demand for producers moves very viciously, and so we had seen a flare up. Now we are going to see a downward lash of the supply chain bullwhip. And so the non-food, non-energy side of the inflation, I think, will start correcting. So all the metals, already the inflation numbers are coming off. So I don't worry too much about global inflation outside of energy being a challenge for India.
So if you look at the Ukraine-Russia conflict, which is still ongoing, and it was expected to end quickly, it is not. Suppose it continues like this, erratically up and down, and then there is no clarity where the termination of the war is really at which place. What is the likely effect, or are there any forecasts that people like you are looking at? Because Russia's oil supplies, gas supplies that you spoke about, and India hardly imports anything from Russia really. So that's not an issue. But will there be a backlash of that effect of the war continuing for an indefinite period?
So my fear is that even if the conflict was to end today, the sanctions won't be lifted anytime soon. Right. So that is my apprehension. And so therefore, the end of the conflict is, while it is, I think, very important from the humanitarian point of view, but from a economic point of view, what matters more is the sanctions.
Okay.
And I think those sanctions may not go away. So I think as we think about the world in the next 1, 2, 3, 5 years, we need to be ascribing a higher probability of energy prices remaining elevated. And there are two factors that drive that. See, for most commodities, when prices go up, demand is destroyed. So that's the whole point of raising commodity price, right? So it's like, someone playing poker or some other gambling thing, and they are as the bids keep going up, some people start folding that I can't afford it, right? And that's so when suddenly there is 5% or 10% less of a commodity, you need to raise prices so that the weaker hand folds, right? And right now, no one is folding. So every single large consumer of oil, the government is subsidizing oil consumption. So Japan, Australia, US, Italy, China, Taiwan, everyone is subsidizing it. Now, which means that demand destruction is not happening. On the supply side, there is very limited additional supply coming through, right? Partly because of the uncertainty that people don't know how long these elevated energy prices will remain. So, which is why I think we should, and remember that whatever oil prices we are seeing right now is when a meaningful part of China is in lockdown to battle COVID.
Exactly.
Just to give you numbers, in April, their airline traffic was only 17% of pre-COVID levels. Right, it was 1/6 of what they had pre-COVID, and of course there is train movement, road movement, etc., freight movement, and all that. So once China normalizes its demand, and once COVID, now they're starting to get lifted. So as that happens, we may see oil prices stabilizing at an even higher level than what we are seeing right now. Right, that is a risk we have to. These are all probabilities, right? Exactly. And therefore, I think as we plan for the next 1.5, 2 years, despite the fact that there are recessionary risks, we should anticipate energy prices remaining elevated for a lot longer.
And just taking the cue from what you said about China's air traffic was just about 17% pre-COVID level. In India, it has come to pre-COVID level in no time. Today, I was reading the headlines in one of the newspapers about Delhi air traffic at the Delhi airport being higher than the pre-COVID level already, despite elevated airfares. And airfares are likely to go up further. So what should an average Indian consumer look at? Will the rupee fall further? Is it a good thing to happen for exports? One knows all that. But is it going to get its natural level? And two, should they be looking at higher home budgets, household budgets in the coming 1 year or so, just to sort of get a perspective?
So see, for the rupee, our challenges, if you think about the country as a household, right? See, we continuously run a current account deficit. What that means for the equivalent of a household is that we consume more than we earn, right? So I think most people in their extended family have some person who is selling ancestral land and consuming, right? I'm not saying India is like that, but we are also selling assets, right? So foreigners hold a very large percentage of our, leading companies, banks, automakers, consumer companies, and all that. And that is what gets us the capital, so that we import dense energy, which we don't have. We import sophisticated equipment, a lot of electronics that we use, and we pay for that using either borrowings or selling our domestic assets. Now, what has happened is that because of the energy prices going up, the amount that we consume from outside has shot up.
Right.
And it will take, I think, 2-3 years for our goods and services exports, which are growing very well. So I don't think this is a long-term problem. This is a very short-term problem. Short-term meaning 2-3 years problem, because goods and services exports will pick up. But while that is happening, you have a sudden increase of $50-70 billion in your what we call the balance of payments, right? So just to give you an example, if suppose you're consuming 120 as a household, you earn 100, you have somehow found 20 rupees of ancestral land that you can sell, but then said that 120 because of some price increase somewhere becomes 140, you cannot find an extra 20 rupees very quickly, and therefore you need to bring down your imports in aggregate, right? And this is what, and so how do you do that? You cannot tell someone to stop eating imported avocado and imported blueberry or whatever, imported salmon, right? That can only be done if you raise prices. And weakening the rupee is, I would say, it's not a good option because it does push up inflation and all that. But there is no good option, right? It is the least bad option. And therefore, as a policy, see, the good thing is we have very high currency reserves. We will not get into very destabilizing depreciation of the currency, which we were used to in the last 20 years. But like 30 years, I would say. And now we are, so we can control the pace of devaluation. So it will be an orderly devaluation, in my view. It should be. And but some weakening of the currency should be anticipated. In terms of household budgets and inflation, I think the year-on-year numbers, economists and most of the Indian commentators look at year-on-year numbers. Sometimes what happens is that the inflationary impulse is long gone, but the year-on-year number is still elevated. So, for example, oil has gone from 70, 75 to 110, 115. And it has been there for about 2 months. But the year-on-year number will remain high for quite a while. One hopes that the inflationary impulse, the incremental inflationary impulse, that is, the monthly deterioration in what the cost of what you buy, is something that will ease after the next 3 to 4 months. So once the rupee has depreciated a bit, and once the global environment, in the global environment, the demand conditions have weakened as much as the current signals are, I think the incremental inflation should start to ease off.
So by the time we get into the festival season, I think things should ease as you see it, hopefully. So on that note, Neelkanth, thank you very much for such a easy explanation of what somebody like me who's a non-specialist thinks is a very complicated subject, and I'm sure our viewers will benefit from what you have said. Let's hope we'll have more conversations, and also when things are slightly better and not as volatile as they are for the moment. But thank you very much once again for joining us.
Not at all. Thank you for having me here. Thank you.
Pleasure. Thank you. So, viewers, that was a masterclass from someone who understands every bit of the economy, right down to the numbers and to the macro as well as the micro picture. Hopefully, you will take solace from what he has said and how the global trends are. That was something that we wanted to bring to you. Do keep watching StratNewsGlobal. You know where to reach us. You know our social media handles. Do subscribe to our YouTube channel. And keep watching and keep sending us feedback. That's valuable to us because then we bring you more such programs in the future. For the moment, it's goodbye.